You pay your insurance company every month. And secretly, there's one thing both you and the insurer hope for. You never need the insurance. Because the moment something goes wrong, billions of dollars can suddenly move in the opposite direction. So here's the strange question. How can a company promise to pay you when disaster happens and still make billions of dollars doing it? The answer starts with one simple idea. Insurance companies aren't really betting that you will lose. They're betting they can predict risk better than the average customer. And that difference is where the business begins. Imagine 1,000 people each paying an insurance company every month. Most won't experience a major disaster, but some will. And that's exactly what the company is preparing for. But here's where it gets interesting. The insurance company doesn't charge everyone the same amount. Your premium is based on how risky the company believes you are. Think about car insurance. A driver with a clean record may pay less. A driver with several accidents may pay more. The company is pricing the probability of a future claim. And this is the part people often misunderstand. The company doesn't know exactly what will happen to you. It only estimates the odds. That's a huge difference. Imagine an insurer discovers that, statistically, a certain group has more accidents. It can charge that group more. Not because every customer is dangerous, but because the overall numbers suggest greater risk. This is called risk pricing. And it's one of the most important secrets behind the insurance business. The company is constantly asking one question. How much should this risk cost? But pricing the risk isn't enough. The insurer also has to collect enough money from everyone to cover future claims, expenses, and still leave room for profit. Suppose 1,000 customers each pay $1,000. That's $1 million collected. But the insurer knows it won't keep all of it. Some of that money will eventually pay claims. Some covers employees, technology, offices, agents, and other operating costs. What's left contributes to the company's results. But now comes something even more interesting. The insurer may receive your premium today, while your claim might not happen for months or even years. That creates something extremely valuable. Imagine collecting $1 today and knowing you may not need to pay that dollar out for years. That waiting period gives insurers another way to make money. This pool of money waiting to pay future claims is often called float. And while the insurer waits, that money can potentially earn investment income. Imagine $1 coming in today, but the insurer may not need to pay the related claim for years. That gives the company time to invest assets while still managing its obligations. This is why insurance companies aren't simply sitting on piles of cash. They invest large portions of their assets, while keeping enough available to meet their obligations. Now imagine something unexpected happens. A huge storm hits a city. Suddenly, thousands of customers need money. That's when the insurer's risk management gets tested. If the company priced the risk correctly, it should have enough resources to handle the claims. But if the losses are far larger than expected, the insurer can face serious trouble. And that's why insurance isn't guaranteed profit. Companies can lose enormous amounts of money. The real game is managing uncertainty better than the competition. Now let's look at the part that makes insurance truly powerful. The company doesn't need every customer to file a claim. It needs the overall numbers to stay predictable. Think about 1,000 car owners. Maybe a small percentage have serious accidents this year. The insurer uses historical data to estimate that percentage before setting premiums. The company knows it can't predict which specific driver will crash, but it can estimate how many claims might happen across the entire group. That's the power of pooling risk. This is where insurance looks less like gambling and more like mathematics. Probability, statistics, historical data, and careful pricing all work together. But there's a problem. The future doesn't always behave like the past. And that's where things can get very expensive. Consider a hurricane. One storm can damage thousands of homes at once. Suddenly, thousands of claims arrive together instead of gradually. This is called catastrophe risk. And it's one reason insurers don't want all their customers exposed to the exact same disaster. Too much concentration can be dangerous. That's also why insurance companies spread risk across different locations, products, and customers. The goal is simple. Don't let one event destroy the entire business. But even that isn't always enough. Sometimes a disaster becomes too large for one insurance company to handle alone. So insurers have another layer of protection. It's called reinsurance. In simple terms, an insurance company can buy insurance for itself. Yes, even insurers need insurance. Reinsurance changes the game. Instead of one insurer carrying every possible loss alone, some of that risk is transferred to another company for a price. So when a massive disaster happens, the original insurer may not have to absorb the entire financial loss. The reinsurer can take part of it. This is one reason the insurance industry can handle risks that would be impossible for a single company to carry alone. Risk gets divided. But there's another side to the business. Insurance companies compete with each other, and customers can leave if premiums become too expensive. So insurers have to balance two dangerous mistakes. Charge too little, and claims can destroy profits. Charge too much, and customers disappear. This is why insurance companies constantly adjust their prices. They study new claims, changing behavior, inflation, weather patterns, and other factors that can affect future losses. And inflation creates another headache. A repair that cost $5,000 years ago could cost far more today. That changes the insurer's calculations. Imagine promising to replace someone's damaged roof. If construction materials suddenly become much more expensive, the original premium may no longer cover the expected cost. That's why insurers don't just look at accidents. They watch the entire economy and the world around them. Because risk keeps changing. And then there's something customers often notice. Claims aren't always paid instantly. The company has to investigate what happened and determine whether the policy actually covers the loss. That doesn't automatically mean insurers are trying to avoid paying. It means they have to verify the claim matches the agreement the customer actually purchased. Remember, an insurance policy is a contract. It describes what the insurer agrees to cover, what isn't covered, and the conditions attached to that protection. That's why reading the policy matters. The cheapest insurance isn't automatically the best. A lower premium can sometimes come with less protection or higher costs when you make a claim. And this brings us back to the original question. Are insurance companies actually betting against you? Not exactly. They're betting on the accuracy of their risk models. They know some customers will have terrible years. Others will have quiet years. The business works by managing the entire pool, not predicting every individual perfectly. And there's one more important advantage. Insurance companies have enormous amounts of data. Every claim can teach them something about future risk. Over time, that data helps insurers improve their pricing. They can identify patterns humans might miss and adjust their models accordingly. But better data doesn't eliminate risk. A pandemic, massive catastrophe, new technology, or unexpected economic shock can still break old assumptions. That's why the strongest insurers don't simply ask, what happened before? They also ask, what could happen next? They run simulations. They stress test their finances. And they prepare for situations that may never actually happen. That's risk management. So now you can see the real business model. Insurance companies collect premiums, manage risk, pay claims, and invest money they hold for future obligations. Their advantage isn't that disasters never happen. It's that they build a system designed to survive the disasters that do happen. And that's why the word insurance can be misleading. You're buying protection. The company is managing probability. Both sides are looking at the same future from completely different perspectives. You want certainty. You want to know that if something terrible happens, someone will help cover the financial damage. The insurer wants predictable risk. And that's the strange beauty of insurance. You're both paying for something you hope never happens. But if it does, the system is there to absorb the financial shock. But there's an important lesson here. Insurance companies aren't magically winning every time. Some years bring enormous losses. Some companies even fail. The companies that survive are usually the ones that understand risk, maintain enough capital, price policies carefully, and prepare for the unexpected. So when you pay your next insurance premium, don't think you're simply giving money away. You're transferring a potentially massive financial risk to someone else. That's the real deal. You accept a predictable cost today in exchange for protection against an unpredictable cost tomorrow. The insurer takes that risk for a price. So are insurance companies betting against you? Not exactly. They're betting on mathematics, probability, diversification, and disciplined risk management. And when they get those numbers right, they can make money while protecting millions of people. That's the real secret behind the insurance business.